Good morning, everybody. Welcome to the Commercial Real Estate Forum. Welcome to the University of St. Thomas. We're happy that you're all down here this morning on a nice summer morning. My name is Herb Towsley. I think I know most of you, but there's a few faces I don't recognize. I'm the director of the real estate programs here at the University of St. Thomas. And so we're glad to be able to co-host with the Finance and Commerce and Messerly and Kramer to put this on. A couple of housekeeping things. For the restrooms, you go out and all the way down to the end of the hall and take a left, and you'll see them down there. And also, if you're here and want to get the real estate or any kind of credits, make sure that you sign in and sign out before you go. So with that, I will turn the podium over to Dave Wegman.
Thank you. Thanks and good morning. A couple of things. One is don't forget to sign up for your credits. If you have not done that, you will hear that on multiple occasions if you haven't heard that already. Herb told you where the bathrooms were. That was kind of the highlight of my welcome. And the fact that I see they've separated Michelle from the boys of the group. Nothing to be taken from that about Michelle's personality. So welcome today on behalf of Messerly and Kramer. My name is Dave Wigman. I'm a shareholder at the firm. There are some cards on your table. As is the case with classes I teach, it would be nice if we had interaction. It makes it more fun for all of you. Objective today would obviously be to have you learn something that you can take back with you and apply in your day-to-day business. That would make us all feel wonderful. And so if you have that opportunity, please do not be shy. You can either write it down and let somebody know, and we'll collect the cards up, or just raise your hand, and we'll be happy to try to answer the questions for you. This is the second year that we've teamed up with the University of St. Thomas and Finance and Commerce, and we appreciate and value their partnership on this, and hope you will all find this to be a very short 2 hours, which is always the objective. We're going to be finished by 10:30, so we are not planning a break. So if you need to get up, please feel free and do so. As is the case with any law firm, we debated that for about 3 weeks, whether to have that or not, and chose not to. We'll decide whether that was a mistake at about 9:45. We're going to have two topics to discuss today. The first is the financing options and trends. The panel that you see here, which I'll introduce in a moment, spent a significant amount of time assembling their presentations, and really hope to give you some ideas that you can take away with you that will help you as you look for strategies with your customers and clients moving forward. The business we're feeling is picking up a little, and some of what we're trying to do is get out of that malaise we've been in, which is kind of focusing on ways to stay out of trouble, and again start focusing on ways to get deals done. So that's our objective. The second panel we'll get into believes that with the real estate economy again moving forward, that investors are actually going to be pulling money out of deals when they close, which is a very good thing. And with that, there will be, again, a movement by those investors to try to protect some of that appreciation from the tax collectors, and we'll get into that with you. So the first thing I'd like to do is just introduce the panel that we have today for our first session. Kurt Appelbacher is a VP with Doherty & Company, where he specializes in real estate financing with an emphasis on multifamily and senior housing, healthcare facilities, and mixed-use projects. There's a much more detailed bio in your packet that you can take with you. Michelle Jester is a shareholder with Messerly and Kramer, practicing in the areas of banking and finance, with an emphasis on real estate transactions as well. And Nick Place is a senior vice president at Bridgewater Bank, where he focuses primarily on commercial real estate and multifamily lending. Nick is a graduate of the University of St. Thomas. I feel like here, if I don't say that, something bad will happen. So I have now satisfied that. So with that said, we'll dig in. The first topic that the group here is going to talk about is just an overview of current marketing and finance trends. So I'll just throw this out to kind of get things moving. What is the current availability of financing options?
I could start. Thanks, Dave. I think the good thing for borrowers is just the current market. There's tons of options available for financing, you know, and it varies across all asset types. I think as banks have improved their balance sheets coming out of the recession, you know, gotten rid of problem assets, and really kind of started focusing on production in lieu of working through the trouble that they've had. That's created a lot of opportunity for borrowers to, you know, or plenty of options for borrowers in the marketplace. You know, it's the low interest rate environment certainly helps. That's a good thing for borrowers. It's not necessarily a good thing for banks. Low interest rates generally mean lower returns and profits for banks. You know, banks can only lower their overhead and their cost of funds so much, so there's a floor in which you can do that. So as banks sit on a lot of cash on their balance sheet as they weren't lending through the downturn, you know, as rates have stayed low for so long, you know, you can only hold out on low margins for a period of time. So as we've kind of sat in this period of low interest rates, banks have really started to look for areas to improve yield and margin. And for banks, really the best way to do that is to get out and lend. So as banks have really tried to get out back in the market, you know, that increases competition and provides a lot of options for borrowers to get their projects financed. And I don't think there's certainly certain asset classes that are more attractive for banks than others, but you know, we've seen competition on transactions that involve you know, speculative construction, land development, you know, just pure commercial real estate, multifamily. So it's really kind of touched on all aspects. So good time to be out looking to get your deal financed, I'd say.
From our perspective, we've seen just a huge inflow of capital, you know, not only chasing projects, but also chasing the ownership of projects, but also chasing the debt side of projects. So a few years ago, while we were sitting around trying to put together creative options to get our projects in the ground, we've seen a lot today that we've gotten multiple bids, not only from community banks, but also national lenders and large regional lenders. A lot of our focus is around the agency finance world, takeout and construction financing. And we've seen those processes even improve in kind of the efficiency of the transaction. So whereas a few years ago, some things would sit around and process for up to a year in some cases, we've seen that streamlined down quite a bit just to get the projects moving while rates are pretty low. So when we're looking with our borrowers on ways to put the capital stack together, I think the debt piece, I don't want to say is the easiest portion, but certainly we've had a lot of competition from lenders out in the market, which makes it a lot easier to get the bulk of the financing done. And then being able to bring in other pieces, whether it's a piece of, you know, bridge or mezz debt, and then putting equity together as well. There's a lot of interest and certainly a lot of capital out there chasing it. So in terms of borrowers on our side, we've seen a lot of folks enter the capital markets on the banking side to get projects built and stabilized, and then go to the agency market or other non-recourse lenders, CMBS or Lifecos, to take that recourse out. And we've seen a really frothy market on both of those sides as well, chasing projects. So whereas, you know, 5 years ago, maybe you had one option or two options for a takeout that may have been expensive and a little bit onerous and a little bit tedious in some of the covenants and loan to values or loan to costs, we're seeing a lot more aggressive lenders out there on that side.
So what are one of the things when I represent mostly developers and borrowers, and one of the things I was asking Michelle about is to try to give us some characteristics of what the lenders are looking for as far as a good deal goes, and how banks are kind of evolving back into kind of partners in these types of transactions. So maybe Michelle and gang, we could talk a little bit about that.
Yeah, I can. So what does a good deal look like for me? Can we say a 10% rate secured by cash held in my bank? No, I think it's what makes a good deal for a lender is probably what you would think is a strong deal that you would own yourself. I mean, something that has, low loan to value, and I would say low loan to value, in my opinion, would be, probably 65% loan to value or better. Strong debt service coverage, 1.5 times or better. As a community bank, we tend to lend with recourse. And we'll get to the guarantee side later on, but so having a sponsor that is experienced, has a balance sheet that includes a fair amount of liquidity, enough to service the debt potentially for an extended period of time. From a sponsor perspective, we look for an ability to make problems go away. And for us, experience with a specific project that you're looking to finance is helpful. It's not imperative, and we've financed a lot of transactions where somebody's acquiring a building. But if you owned a building pre-recession and owned it through the recession and are looking to refinance debt on that now, well, that's a fair amount of tenure and experience with that specific project. So that can help a local lender to look at, well, hey, this owner is able to weather the storm on this building and make it through and still be in good financial shape. So that, I don't know, I kind of touched on a few points, but it kind of gives a frame of reference as to some of the things we just at a high level look for a deal to be considered really strong.
So the next topic we were going to get into is the financing options and the underwriting during construction up until and through stabilization. Again, what kind of loans are available? And I think we'll start with Michelle on this from a legal perspective, or
the drier side of the story. So generally from a standpoint, when you're in construction, you're talking about projects that have more risk. So you're going to see it in the structure of the deal and the pricing on the terms. Nick can get into more specifics about kind of how they price them, but you are going to see more due diligence collected with respect to the project with the lender. They're going to want to know that the numbers flow. They're accepting risks that you might not get the project leased up. There might be cost overruns and other things. So when they're asking for due diligence, they want to make sure not only that the numbers match, but that they're also taking a hook as a security interest in various components like your construction contract, your architect contract, and the other pieces, so that if you, for some reason, are unable to complete the project, that they can step in and they got a complete understanding of what's going on there. The other thing that we're seeing more of, too, and the issue doesn't always come out right away, is the issue with early start coverage. So if you have any improvements on your project or any work's been started, you should not only let the lender know, but the title company know as soon as possible, and preferably before any of that work starts, so that everybody can take a look at that and determine if you can get your early start coverage. It's a little more tenuous once you've already started that work, and then we're trying to collect financials and take a look at that, because a lender is going to want to be in their proper first lien position when they do that project.
Yeah, and Michelle mentioned that just in general, construction financing, there's a few additional risks associated with that aren't maybe included within a stabilized asset, right? So you've got construction risk that it's going to get built, and it's going to get built, on time and on budget and correctly. So, we certainly underwrite the contractor as part of our due diligence process. Michelle mentioned the lease-up risk too. So, I mean, if you've got a transaction that's maybe a build-to-suit and 100% pre-lease, that obviously gets easier to underwrite because that's one of the risks that we're looking at. That's essentially taken out of the transaction. Relating to structure and how we're looking at getting construction projects put together. Obviously, coming out of the recession, there wasn't a whole lot of appetite for construction within the banking realm. But as the economy gained some traction and things started to improve, and we saw that there was more activity there, and a lot of banks kind of jumped back in. So where underwriting criteria really tightened coming out of the recession, it did start to loosen a little bit. I mean, banks are maybe a little bit more willing to accept some, alternative forms of equity, so to speak, deferred developer fees and other types of things that we could maybe allow as a component of the equity requirement. If you haven't heard about the high volatility commercial real estate and what that's doing to change the underwriting criteria for banks, and if you're a developer, I think you should probably spend some time looking into that. There's been some guidance given from the FDIC and other bank regulators that pretty good Q&A, and I can get that to you if you're interested in putting yourself to sleep. But the nuts and bolts of it related to how that's changing underwriting criteria is that it's created some very hard and fast minimums for banks as they look at a construction and development project as to what the cash equity component is from a borrower. So before, you might just need to say you need to be at, 75% loan to value with equity of, 15%, let's say, or 20%. And that could come in various forms, deferred developer fees and other, land contribution and things like that. Well, today, with this high volatility commercial real estate, what it does is it requires that a borrower has 15% cash equity into a transaction. So, deferred developer fees don't count. You can't. They won't even allow you pledge additional unencumbered assets as to count as your equity component. So you could have a $2 million apartment building with no debt on it that you said, well, hey, can we just wrap this in as collateral in the transaction? Well, no, that won't work because it's not cash. The only collateral they allow to be pledged is readily marketable securities. So, and what that does for banks, it doesn't preclude us from doing those transactions. It just results in a larger amount of capital that we have to hold against that loan on our balance sheet. So essentially, the same loan, let's just say it's priced at 5%, that is not a high volatility commercial real estate transaction. If it becomes one, we have to deploy 50% more capital against it, so that loan immediately becomes 50% less profitable for us on a return on equity perspective. Almost all banks are doing some sort of profitability analysis on their loans to see, is this meeting some predetermined hurdles as to this type of asset class? Is it going to meet the return on equity component? So if it becomes a high volatility commercial real estate loan because you have less than the required cash into the deal, a lot of banks just flat out aren't doing them. The banks, we've done a few of them. In the instances that we have, it's been a transaction that's short-term in nature. It might be on the balance sheet for 6 months. It's typically, they've been accommodations for long-term existing clients that we have. But it makes that transaction less profitable unless you price in that additional cost of capital that we have to deploy against it. As we've kind of crunched some numbers and talking with some other lenders too, it's probably anywhere from 75 to 125 basis point increase in your rate if you are not going to meet those minimum cash equity requirements. So that's been a big change into how construction deals are getting put together. We have some borrowers that, Kirk kind of mentioned some of the alternative sources of capital and some bridge financing. So, for example, if we've got where a project might have TIF and you look to finance that TIF as part of your equity, that's a deal that I would maybe look at in terms of financing that TIF before. Well, that may not count any longer because you are not providing that cash equity into a transaction. So it changes the structure of some of these more complex construction projects. And again, it doesn't mean that they can't get done. It just means that they might get priced a little higher. I probably sufficiently avoided talking about the actual price, right?
So, recent project I've been working on, since the time the project kind of was dreamt about, to now the point where they're working with the bank, pricing on that construction project has gone up 10 or 11% just because of what's going on in the city. So they're having to now look at, they've got equity guys are all lined up and all that. Now they've got a 10 or 11% cost overrun, and they're looking for mezz debt or some short form of financing to hold that over through the construction loan. What are the feelings from a lender about that? How we're kind of handling this delta between the price increase and kind of the original budget?
Yeah, and I don't think that's something that we don't look at that often. There are cases where we've, entertained transactions like that. Financing that delta that you're talking about, where I'm going to make the broad assumption that I can't get my hooks into anything related to that project. We're going to need some form of pretty tangible collateral to make that work. Unless you're talking a sponsor that's willing to, unconditionally guarantee that transaction and they have a pretty sizable balance sheet. But we've looked at those types of transactions, and you tend to try to, we want to be able to get in and get out as quickly as possible. So we tend to keep the maturities and balloons on those pretty short, specifically tied to the project and when it's going to be completed. Hopefully Kurt's all lined up with his takeout financing and can wrap that payoff into it. But I think there's appetite for that if you're talking with the right lender, and certainly I wouldn't try to broach that subject with a new lender, one that you haven't done transactions with in the past. That it doesn't mean you can't do it. It just that's going to be more of an uphill battle than maybe talking with a familiar lender.
Great. Well, that will be our segue into kind of stabilization and the availability and types of financing on a more permanent basis. Kurt?
Thanks. And just to touch a little bit on construction, sorry to back up a little bit.
No, that's fine.
But kind of one of the most recent turns of events we've seen lately is lenders and agencies really looking at markets and rents, really kind of the fundamental underwriting of these projects, but not putting the credence in the market study or some of the forecasts that are out there right now. I think there's a little apprehension of absorption in certain markets, whether it's the U or the North Loop, projects like that. So we've seen a lot of pushback and kind of re-underwriting and redoing a bunch of pro formas just to kind of figure out what those returns need to be, which all segues into that permanent piece of, are you going to get the rents that you think you're going to get, and how fast is this going to fill up? Usually you see the kind of 12 months to build it, 24 months to fill it model that's put into the project. I think banks like Bridgewater or others that are out there, you're going to see kind of these construction mini perm loans that give you a little bit of breathing room to transition into your permanent financing, whether it's a 3 or a 5 year type of structure. We've started underwriting projects on the Fannie Mae side before stabilization, just to kind of get the numbers set and get people out of that recourse construction financing as soon as possible, and to try and just mitigate any risk in the future. So whereas your number, you may get a nice appraisal kind of out of the gates as stabilized. We'll try and get you into that perm piece as soon as we can, as soon as you've got kind of the sustained occupancy to support that type of loan. Other sources of capital, certainly in the CMBS market, there has been a lot of activity and will continue to be a lot of activity from not only the new projects, acquisitions. We can't pick up a Finance and Commerce or any other kind of trade publications without seeing just massive transactions in liquidity, trades of huge projects. So we've seen a lot of demand on the acquisition side as well as the refinance side, from kind of the wall of refinances coming from the 05, the 07 market that'll be rolling off their 10-year debt coming this year through the next 2 years. I think we've seen a very active market, certainly with the B-piece buyers that really drive kind of the flexibility of the CMBS market. We've even seen some life cos be pretty aggressive with alternate pieces, whether it's a mezz piece or a bridge piece, looking for a little bit more yield from kind of the low margins that they've got right now in their core portfolio loans. So that's an ongoing conversation we've had with a lot of folks. Certainly, if you don't get a valuation that you need to for your refinance, there's a need for that kind of mezz piece in between to take out the existing financing. So I think all of our core sources of kind of long-term permanent financing without recourse, life cos, CMBS, and agencies are really frothy. In fact, Fannie Mae has even tapped the brakes, and Freddie Mac have tapped the brakes, pushing up on their debts, or the allowable amount of debt that they can issue in a year. The target was, I think it was $30 billion, and they've recently put a couple of pricing increases to slow production to kind of keep in step with what the goals are for the overwhelming year. So a lot of demand out there. I think a lot of sources, and it'll be interesting to see how it all shakes out. Especially, and we can talk about rate increases in the future here, but certainly right now people are pretty aggressive to try and put these things away and get them out of the bank market.
Thanks, Kurt, for saying everybody's trying to take their good deals out of our banks. But no, Kurt probably has more flexibility in options for probably 10-year money and longer with non-recourse. I would say for most, small to mid-size or regional banks, kind of the ceiling on term is about 10 years that will typically go out. Now, we can provide 10-year fixed rates. I've got a 10-year fixed rate that I send out on term sheets somewhat often. I haven't seen anybody take it lately. It must not be very attractive. But where I see a lot of our clients kind of landing in the realm of structure and pricing on a stabilized asset is, we'll in a lot of cases do a longer term maturity, maybe a 9 or 10-year maturity with a few interest rate resets within that. So, that allows, we can be more aggressive and more in line with market pricing on, on a 3 or 5 year fixed rate. And, for us, we're not taking that really long interest rate risk. It allows the borrower to take advantage of the short end of the curve, which is, still attractive and low, but not have a balloon over your head, 5 years from now. So essentially in that structure, the rate would fix today for the first 5 years. Prepayment penalties typically burn off, on a declining scale as you get close to that first reset. And there'd be no prepayment penalty in the year leading up to that reset. And the reset structure is typically predetermined, at loan closing. So we typically price off of treasuries. So if you're looking to do a 3-year reset, we'd price off the 3-year treasury plus some sort of margin, anywhere from 200 to 300 basis points. So as you're leading up to that reset in that year, you can start to look at, well, hey, where our treasury is sitting, it's a 5-year, it'll reset at the 5-year treasury plus 250 basis points. That would price today at this. Is that rate in line with the market? And, are you okay with that? Or, hey, you've got no prepayment penalty. You did have transaction costs, but, you wouldn't really be penalized in refinancing that out. We've seen a lot of our borrowers tend to take that sort of structure, which provides a little bit more flexibility than, fixing a rate and having some pretty hefty prepayments, certainly in the first half of that term.
Are there any particular types of loans? I mean, right now it seems like there's an awful lot of multifamily housing. Seems like senior housing is picking up steam again. Are there certain types of loans that are viewed more favorably for certain types of projects?
Yeah, I mean, multifamily is still attractive. There's, Kurt mentioned there's some, it depends on the asset type. I mean, given our size, apartments are probably a third of our portfolio. Our typical apartment transaction is your 60s vintage, Class C property in South Minneapolis. So that type of asset hasn't, is still attractive for a lot of lenders. Those vacancy rates are really low. Price per unit has certainly come up, but if you're refinancing something that certainly you'll see a lot of appetite within the banking market for that type of product. But as owners are looking for yield and kind of looking at other asset classes, we've seen a lot of activity in other segments. Retail is actually doing really well. We've done we've a fair amount of development work, putting up really well located infill retail type projects. A lot of times those are almost 100% pre-leased before they even start moving any dirt. So those transactions are doing well. Even existing well-located retail is doing well. And then a lot of our clients are investing in pure commercial properties too, industrial and office. There seems to be a fair amount of activity there. We are a real estate focused bank, so it's real estate we tend to like it. But there's certainly we'll look at just about anything. I usually say I'll look at anything. I'll let you know pretty quickly if it's something I can do.
I think Dave just mentioned an interesting piece too with the senior housing kind of component in this market. Historically, the Midwestern model has been really not-for-profit driven, And in the last 5 years, we've seen a lot of for-profit enterprises enter that market. And as our banks and as our kind of agency platforms and even into the bond market in some cases, we've seen kind of an increased focus on different pockets, so really micro markets of saturation in something like that. So I think a lot of folks look at that senior housing piece, certainly on the debt side, as a way to grab a little bit more yield than just a traditional apartment or retail or industrial type of a piece, because there's that business component in there and it perceived a little bit more risk because a lot of the revenue comes from services instead of just pure rentals. So we've seen a lot of folks focus on that and get comfortable with it, whereas 5 years ago they wouldn't really look in that market. So I think there's a better understanding of that. Certainly everyone's aware of the quote-unquote silver tsunami coming down the pipeline of aging baby boomers and certainly the greatest generation in those facilities now, and kind of the new demand of everyone's got the picture of a nursing home with people in wheelchairs in the hallways sitting there with their heads down. That's not going to be the case in the future. People want high-end housing. There was just a groundbreaking last week for the first kind of high-end senior facility in downtown Minneapolis, and I think we'll see more and more of that. In putting the financing together for that, we saw a lot of lenders bring a lot of interest in some very aggressive term sheets to the table. So I think that's kind of an interesting turn that we've seen happen.
So another topic that was discussed internally was this idea of assigning and assuming certain loans and what that process is really about and some of the risks to a potential assignee borrower and what might be the benefits. So this is your law lesson from Michelle.
So we're seeing more requests where people are asking for a loan to be assigned from one lender to another, and why would someone want to do it, and what are kind of the benefits and risks. And one of the reasons that people would look at doing it is to save on mortgage registry tax. So if you have like a $10 million loan out there and you assign it, you could save in Hennepin and Ramsey County at least $24,000 in mortgage registry tax and not putting new financing out there. Another reason might be that you've got some other liens out there on a property, or you've got priority issues and you're not going to be able to get your lender back in the position you need. So you assign the current loan there so you can maintain your lien priority. Some of the things that you need to be cognizant of as a borrower is lenders aren't always excited to do this because they're inheriting somebody else's documentation. So the lender that's assuming the loan is going to want to take a look at the documentation. They're going to want to know from the lender that's assigning it that they have authority, they're the holder of the documents, and usually the lender assigning it is going to do it without recourse, meaning they're really going to make some minimal representation. So what you should expect as a borrower is that there's going to be some request from you to waive any claims, any claims against the lender, offsets, anything, defenses through the date of the loan assumption, because they really want to assume something that's clean and put together in a nice package. There's always, once the loan is assumed, the ability for the new lender to kind of amend and restate. In other words, kind of redo the loan documents, put them on their own forms, terms that they're familiar with. If you're doing it for a money or a lien priority reason, you may not care, but as a borrower, then you're going to have another set of loan documents that you need to get familiar with.
What about the risks? So people there would be, in my view, there might be a tendency for a maybe not so straight up current borrower to want to get out of that particular loan and go to maybe an unsuspecting buyer and just saying, look, I just need to sign this over and you can assume my debt and start making payments. What does a borrower, or what does the existing borrower or a potential assignee, how do they protect themselves? What kind of are the steps maybe they should be going through to make sure that this is going, if you're the original borrower, you're getting a release, and if you're the new borrower, assignee coming in, you're not picking up a hornet's nest.
Yeah, so I would say the assignment and assumption of loans from the borrower side are less common, but what you're going to probably need to go get your lender's consent because there's going to be a due on sale provision in the loan documents where you can't just transfer one borrowing entity out for another unless you're doing some kind of a membership or stock type of sale under it, which is unlikely. So you're probably going to need your lender's consent to do it. The other problem that Dave talked about is you end up inheriting these loan documents that got terms in them and you're not familiar with them. I have seen them happen. We had a file 6 months ago in our office where that happened, and they kind of walked into a can of worms where somebody inherited a whole bunch of problems. You can try to get releases or put together other types of, kind of risk mitigation pieces where you're going to put it back on the borrower, but if it's a single purpose entity or that's all that borrower had, unless you're getting something from a principal or somebody else, there's potential exposure there.
So guarantees and other forms of kind of financial assurances that banks might be looking for. I guess we could talk a little bit about what types of guarantees are typically required, the full kind of full recourse guarantees, the carve-out guarantees, those kinds of things. What's the appetite of the banks? Anything new there?
So typically on the community bank side, you're still going to see full recourse guarantees. If you've got multiple individuals that have ownership interests in an entity, you might see guarantees that are joint and several based on the ownership interest. So if you got 4 people and they each own 25%, you might see 125% of that 25% interest of the total loan amount. The other thing you probably need to be cognizant of is what I said, either are they joint and several, so you're all in kind of for the whole thing, or are they several where you each just have your specific portion of the loan? Is it just on the principal amount of the loan, or is your guarantee include all the add-ons, interest, late fees, attorney fees that can become part of it? On some of the limited community bank loans, you can get some of the carve-out guarantees, which you might see more so with life insurance and some other financing from larger institutions. On the carve-out guarantees, you're really trying to deal with things that are outside of the typical market forces. So you have the below the line where kind of what are the actual damages the lender has for certain things like security deposits, misappropriation of rent, and certain things like that. You have the other piece, which is kind of the springing piece, which turns into full recourse. These are things like if you have fraud or misrepresentation, if you have insolvency or bankruptcy, which is a very hot topic, and you might see some negotiation on that because there's been quite a bit of litigation around the topic. If someone's insolvent, then does it really make it into a recourse guarantee where a principal then becomes fully liable for the debt? So there's a fair amount of negotiation that can go around the carve-outs and how they're structured. Obviously, the borrower's trying to minimize their exposure, either try to make it a below-the-line item or try to carve out things that aren't in their direct control if they have employees that are working for them, so they're not responsible for their fraud or other things, or they only have to be responsible for damages if they did something willful or grossly negligent and try to minimize their exposure.
Yeah, and from a community bank's perspective, and like I said before, we tend to lend with full recourse. I think that's generally where we, in most banks, start and assume we're gonna finish. I think for me anyway, I mean, recourse is something that's relatively easy to negotiate down a little bit. The structure that Michelle talked about, where if you have multiple partners and you limit the recourse to each individual to a certain percentage versus doing, unlimited joint and several on each individual partner, that can be palatable. I think that makes the broad assumption that, as you look at the balance sheets of each one of those sponsors, that there isn't, one that is really adding to the strength of the transaction and really making the deal work. In that sort of instance, we might require, a higher recourse percentage to that one individual. But going through the downturn, we foreclosed and sued through our fair amount of debt. I don't remember one instance where Michelle did a lot of our legal work, where we relied solely on our guarantee to get us 100% of our loan amount. I mean, it just typically doesn't happen. It is an arrow in our quiver, so to speak, as you're litigating something out, and a piece that can be negotiated through. But I think recourse is something where we expect, but there is a little bit of flexibility as to how we structure that.
So there's been a lot of education given to developers and investors throughout the last 10 years. And what I'm seeing too is this increase in the desire on borrowers to in effect harvest some of their assets, put them into some form of holding company in order to protect those assets, and then keep a certain amount in another entity to use for their operations. So in effect, they're not using their entire net worth to guarantee every project. They're using assets from either a holding company or some form of a trust, but keeping a certain amount of that wealth away from their business operations. Can we talk a little bit about what you're seeing in that area?
Yeah, I can. We've had a few borrowers that have done that structure. I mean, you certainly need to have a portfolio of properties that's substantial enough to where you can start segmenting out, and it makes sense to go through the legal side to do that. The transactions where we've looked at that entity providing a guarantee in lieu of an individual directly, the deals themselves tend to be, kind of middle of the fairway sort of transactions. I mean, ones that are, if you're talking about a apartment building that's been, owned in their portfolio for 10 years and it's, has 65% leverage and strong debt service, and we might typically require some small component of personal recourse. Well, in that instance, we might accept a holding company or as a guarantor in lieu of an individual. So we have not done them on transactions that are speculative in nature. They tend to be very seasoned, stabilized assets that are pretty easy to underwrite, and the likelihood of us having to go to that guarantee is pretty small.
And just kind of to touch on a couple alternative strategies that we've seen in the market, especially with the guarantees. A lot of folks actually in Minneapolis do affordable housing pieces, whether it's a full affordable project or even up to 20% affordable. It really changes kind of some of the financing options that are out there. With in some cases, if folks get TIF for their projects, there'll be an affordability requirement put on by the city through the duration of the loan. With that, I mean, if you've got an affordability component, you can get 4% tax credits. It's not going to generate a lot of equity for your project, but you can access the bond market. 4% credits come with the availability to issue tax-exempt bonds to fund your project. So we've seen a lot of for-profit developers. There are several in town that are very active in this type of financial structure. Access the bond market, which is a fundamentally different underwriting criteria than kind of the traditional bank market, and how you look at the guarantees changes a little bit. So in some of these acquisition rehabs or even new construction, we'll need a guarantor on the hook just through stabilization. And we've been able to get a little creative with those types of guarantees, whether it's a holding company, whether it's several other cash flow from several other stabilized assets, and not having the principals have to put their full balance sheet behind that guarantee, and also seeing those step down at stabilized occupancy and debt service coverage. I think debt service coverage is kind of the biggest underwriting factor in that tax-exempt market. And if you're going to issue bonds, you can also get your allocation to issue some sort of mezz or subordinate bonds in that type of a structure that will need the full guarantee through the duration of the loan. But on the senior piece, you can have step down or burn off types on your guarantees, and alternate structures. As we're underwriting those and bringing those to the market, we're really going to look to the financial stability of that guarantor, the sustained cash flow, historical cash flow of the entity that's doing that, whether it's a holding company or some sort of sub LLC that holds some other assets that the cash flow kind of upstreams to. So just kind of some alternate strategies out there.
Yeah, I'd reiterate that point that Kurt just made about, if you're going to try to utilize that structure where you're setting up a holding company, I mean, we're going to dig into the viability of that entity providing some strength to the transaction. So, I mean, there's going to be, a fair amount of due diligence required to, see what assets do they hold, what's the, occupancy level and historical performance of those assets, what sort of cash flow, what is the debt structure like on the assets within that holding company, so that we can get pretty confident about the likelihood that that cash flow is going to continue. I mean, it's looking at a personal balance sheet, it's pretty easy. It's a lot easier to understand, kind of the structure and how the strength can be provided. So if you're looking at an entity that's a holding company for assets, you got to really dig down into each one of those.
So before we get into predictions, anybody have any questions so far that you'd like to ask on anything that was said? Yes.
I'd accept anybody who wants to guarantee one of my loans. So the more the merrier, the better. But if it's needed to get the transaction done, meaning maybe the principals, don't support it themselves or have some, black mark on their record that is maybe precluding them from getting financing otherwise, we're gonna dig into their balance sheet pretty hard, and I'd ask our attorney and really make sure that there isn't going to be any sort of loopholes on the back end that somebody can, squirm out of that guarantee just due to consideration. So that side of it would maybe be we haven't looked at it a ton, but I mean, I think that would be my biggest concern on the front end is just their ability to I assume that if you had to litigate it out, that's going to be their first defense, but to make that pretty firm that there was consideration and that, their guarantee is valid. So I don't know what your opinion is of that.
Yeah, I've seen it more in the workforce or affordable housing arena, honestly, than I have on straight market deals. And it seems like on some of those deals, the mission kind of succumbs all business reasonableness. So I've seen third parties come in and provide guarantees on them, but not so much on the market.
Yes.
My question is similar to that.
Well, I think as long as there's, if we look at the sponsorship group as a whole, as long as we feel like there's sufficient strength there, even though one person may not add much or may have some sort of issue that kind of is hanging on from the recession. We have transactions where we have those people as guarantors still, but we're really relying on the strength of the others to make the deal work. So I don't think it would stop us from doing a transaction necessarily, unless it's something the black mark is if that guy defrauded a bank, I might have an issue with it. But if it had fraudulent a lawsuit with a bank. If he robbed a bank, yeah, that's probably going to stop him. But we'd look at the rest of the guarantor group and just to ensure that they provide the strength that we're looking for. So.
Yeah, I mean, I think what Nick said, they still will take everybody's guarantee, but you look at it as a business whole. But I think what we see more of in the market now is the request as there's more investors in projects for there to be a substitute guarantor. So maybe an investor is going to want to step out, or they're anticipating that might happen at some point. So there's more requests to build some concept in language in a narrative format that there can be a substitute guarantor come in at some point. And obviously that's going to be subject to underwriting and things at that point, but they want that flexibility for that option and then to look at it already in the documents.
Anybody else? So predictions, which is always fun. I guess where does the panel see where are we at in the current financing cycle? What about rates? Just talk a little bit about the crystal ball.
You go. Yeah. Well, I've been wrong since 2009 about rates going up, so I'll just keep on eventually I'll probably be right. I think rates will likely go up. In terms of where we at in the financing cycle, I'll maybe start there. The financing cycle follows just the general economic cycle for the most part. It's tough to really get a gauge on where we're at economically. It seems like there's some signs that point to things are really gaining traction, and then there's other signs that point to where we're struggling. So I typically just go with my gut and say that it feels like things are getting a lot better out there. So I would think that we're probably on the upswing and probably going to start to plateau off as we talk about the financing side of things. I think as rates start to tick up, and I think my prediction on rates is I think the Fed will probably move the Fed funds target, not likely in September any longer. I would have said that in June or maybe September earlier in the year. I'm thinking by the end of the year, there's probably going to be at least a 25 basis point increase in the Fed funds target. Now, I don't think that that'll do much for long-term rates. You had to pin me down. I mean, my prediction is that rates probably flatten even more than they have, and short-term rates come up, and long-term rates probably stay relatively steady. But the beginning of last year, I think there were 90. I read something. There's like 96 economists that were polled in January 2014, and 87 of them thought that rates were going to increase through 2014, and long-term rates were down 100 basis points. So I don't know. You just got to figure it out. It's a crapshoot, but I think they'll probably go up on the short-term side of things. They'll start to sometime this year.
I really wish I had a clear answer, and I don't. I think we can all just kind of make things up as we go here and say, yeah, rates are going up. But we see, on our side, we're seeing, and I'm sure all the other lenders in the room here are seeing it too, just a tremendous demand for loans that are out there, not only refis, but also new construction. I think a lot of developers are kind of of the mind that rates will go up at some point, and how do we position ourselves or get in the ground now and then kind of work into a permanent piece before that happens. So I think there's a lot of rush to try and do that to get the projects that, we've seen just huge construction over the last 2 years, get those stabilized and put into something permanent. I think kind of an interesting micro market or microcosm of the overall market is the North Dakota market. I know there are talks and panels and all sorts of things about what's going on up there, but it's been an interesting piece. We've lent not only on the multifamily side and the hospitality side, but also on the infrastructure side. And there's been a giant slowdown just with the price of oil coming down and seeing the change in the labor market up there. And as Nick mentioned, where are we in the economic cycle overall? I think if you look at North Dakota, where there's a pause and there's not the demand and not the high wages that are going on and not the high rents that are coming in, we're seeing a little bit of an adjustment, and it's probably a good thing instead of kind of the boomtown slap up kind of the shoddiest product that you can get or cheapest product you can get if you can get workers to build it for you and charge someone $200 a night sort of model. I think on something like that, we're going to see kind of a more family, I don't want to say family-oriented, but a little bit more family-oriented where it's not just demand camps that are going on. So it'll be interesting to see kind of the metropolitan markets, how that trickles out with the cycle of development that we've had. Certainly in North Dakota, I think it's a good thing just to kind of correct the full throttle development and going that's been going on so far. But I think that could mirror things in the future for the overall market of maybe just a little cooling off of certain markets in the apartment world, just to see kind of what the millennial generation is going to do in terms of having babies and moving to the suburbs or not, or staying in metropolitan markets and renting. So I think a lot of those variables will come to play in the next few years, and I think that'll be the most interesting piece whether the apartment boom continues to happen or not, as baby boomers move out of their houses, what happens to housing prices as well. I think drives a lot of what we all do in this room. So we're still optimistic in the market, but I think there'll be an interesting perspective over the next 3 to 5 years of really how the kind of macro housing demands and trends pan out as people start to age.
Yeah, and Kurt mentioned the competition side of things. I mean, that's what'll really on the local bank side, that will dictate rates just as much as what the Fed does per se. So as banks have become healthy, like I said when we first started, and are out in the marketplace again, I mean that forces me as a lender to sharpen my pencil more so than what national rates are doing. I mean, we have 4 locations in the Twin Cities. 95% of our portfolio is local. I mean, we're a micro-focused bank in a local market. So if there's other banks that are entering into a market that maybe weren't there before, into a segment or an asset class that typically weren't there before, that's going to drive down rates because banks are going to have to get competitive to keep their deals. I mean, we've done construction lending, since we opened our doors in 2005. We continue to do it today. We did it through the recession. But there's a lot of lenders that are hopping back into doing construction financing, and that's giving our borrowers options. So for us to, keep deals that we've had and relationships that we've had, we have to make concessions on pricing and fees. And that has little to do with what national rates are doing. So that'll be the governor, so to speak, as to how much upward pressure there is on rates. If banks continue to be aggressive in the marketplace and provide a lot of options, that's going to be good for borrowers. It'll keep rates low.
Michelle?
And I think the other piece to what Nick's saying is I hear a lot in the community banking market that we're going back to the pre-2008 pricing and terms. And so if the market corrects or something, we will see how those terms pan out for some of those lenders because they're not always good, smart business decisions in putting it together. But I also think there's going to be a constant regulatory pressure on the banks, whether it's from their oversight agency or capital ratios or other things coming out. And what I'm seeing from a lot of the larger lenders putting in their loan documents, they're trying to push some of that risk off on the borrower. So if there is some readjustment on capital ratios or other things, they're saying the borrower is going to have to make up that shortfall. And I'm seeing a lot less of that happening in the community bank market. So again, it's going to be terms and pricing pressure versus relationship and having someone that you can deal face-to-face with. But I see that playing out over the short term here as well.
Well, great. Any other final questions? Yes.
We don't swap anything on our balance sheet. So no, I would say that's probably the case for most community banks. And from a community bank perspective, I would say if you're under, $1 billion in assets, you're probably not doing much for swaps. I mean, for us, you're right. We don't do a lot of 10-year fixed rate financing. So what we can do is we can look at our portfolio and segment it based on maturities of our loan. And we can see, well, hey, yeah, our balance sheet maybe isn't structured really efficiently to do everything in our portfolio as 10-year fixed rate. Now, that doesn't mean that there isn't a place in our portfolio for some 10-year fixed rate deals. I mean, for example, I did a 10-year fixed rate deal on a retail strip center in 2011, and it's at 6.75%. And I'm like, yeah, today I'm really enjoying that rate. I mean, back then it was a little squirmish to give that rate out, but there is a place in the portfolio for some longer term fixed rate transactions. Well, we will include, covenants where, there might be a debt service coverage minimum. So, well, it's an event of default, but it's, yeah, typically. In the event that that default's not cured, yes. So there would be some risk assumed with doing that if a lender has a debt service coverage covenant built into that transaction. Yeah. But practically speaking, if a deal is paying and working, I'm not usually in the business of making problems for myself. So if you've got somebody who's willing to continue to support a deal because the debt service coverage ratio has fallen below a minimum or is even below 1-to-1, that might be an option for me to say, well, hey, do we need to right size this debt a little bit? Do we need to do something? But calling a note due and litigating something out is, if I've got a good rate and a good borrower, I'm not typically looking to kick that loan out of my bank.
Great, thank you. We'll now have a short musical interlude.